morning, everyone, and welcome to the BetaShares Economic Outlook, shaking off COVID and can markets fight the Fed, with David Bassanese, the BetaShares Chief Economist. And just a bit of admin to cover off before we get into today's webinar. I'll get everyone just to have a quick read of this and pointing out, of course, that past performance is not indicative of future performance if we reference any funds today. As always, we'll be recording today's webinar, so if you need to pop away for any reason or want to go back over anything covered, we'll be sending that at the conclusion of the webinar today. And thank you to everyone that's already sent across their questions. We'll be having some time at the end for David to cover those, but if any more questions come up through today's webinar, just use that little question widget box there and type them through, and we'll endeavour to cover off as many of them as possible. As always, we'd like to make as much content as available to our Australian investors so they can make informed decisions around their portfolio construction. So do jump on our website. There's a heap of information there in terms of fund data, blogs from our investment and distribution team, along with all that investment information on the funds. We also have a stack of regular content that you can sign up for, and one of our more popular ones, of course, is Bassanese Bites that comes out on a Monday. And you'll be across all that content, blogs, fact sheets, and new fund launches by following us through our social media pages on Twitter, LinkedIn, and Facebook. So a bit of update on BetaShares today, and hopefully most of the people who are attended are already BetaShares supporters and investors, but welcome to anyone that is new to BetaShares and this is their first webinar. BetaShares, we offer a range of ASX listed ETFs, and that's at 69 currently, and that is a broad range of strategies and funds from low-cost ASX 200 exposures at 7 basis points to international and smart beta exposures, all the way to active strategies as well. So really helping our ASX and Australian investors really build out a diversified portfolio utilising ETFs. We manage over $23 billion, and again, thank you for all your support and taking the time to select our funds. And our objective here at BetaShares is to create innovative and intelligent investment solutions which help Australian investors meet their financial objectives. We have David Bassanese, our Chief Economist here at BetaShares, to cover off the webinar. My name's Chris Yates. I'm one of the directors here at BetaShares, and again, thank you and welcome all to the webinar. David's responsibility for BetaShares is developing economic insights and portfolio construction strategies. He is also the chair of our investment committee for our own internal portfolios we manage, which also those asset allocation insights are played out in terms of some of those diversified ETFs that we have on the ASX as well. David was a former economist at the AFR. He was also a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, and Treasury and OECD economists. And above all this, along with having a family and everything else, he also wrote a book, which is called the Australian ETF Guide. And I'd highly recommend jumping on and getting that book to give you some insights in terms of how to build a portfolio, understanding ETFs and portfolio construction. So in terms of the agenda today, Fed on the warpath, David will be looking at what's really forcing and playing out on the global markets that are forcing the Fed to raise interest rates. That also, he'll be going into, will the RBA follow? So given what's happening in the US and the Fed, will play out here domestically in terms of interest rate rises. A bit of a COVID update covering, I guess, the latest Omicron wave and how that's played out in terms of different sectors and markets and how that's affected them. And then he'll also be covering off some investment themes, looking at if there is inflationary and interest rate expectations, what are some of the potential ways that you can position your portfolio to benefit from that, and also looking on the contrary to that to see if the global economy continues the way it was pre-COVID. What are some other sort of secular growth things that could potentially play out as well? So I will now pass it over to David. I'll jump back in at the end to cover off those questions. So again, please do write those through as we go, but I look forward to speaking to you and enjoy the webinar.
Thanks very much, Chris, and yeah, sorry for that technical issue there. I think I just pressed the wrong button and something exploded. But anyway, let's press on. So I'll start off with the the Fed on the warpath and just going through really the biggest development in the past, since the last webinar has been the Fed pivot. The Fed, just a quick history, we do know last year, if you're following the markets, that inflation around the world, particularly in the US, did accelerate on the back of what we call supply chain bottlenecks. A lot of very strong demand in the US, underpinned by fiscal stimulus. So there was a lot of demand for goods, a lot of which needed to be imported from Asia. And Asia, through various, and Asia, due to COVID, obviously had various shutdowns, disruptions to factory production. But bottom line is we had a massive imbalance of supply versus demand, and those shortages led to a surge in prices. Now, for most of last year, the Fed was sort of looking through that surge in prices and saying, we think the inflation is transitory. And so they, didn't raise interest rates through last year. The markets were counting on it at one point, but it didn't happen. They were pricing in rate rises for this year, but the Fed was sort of saying, we don't think we'll need to do that. But late last year, Chairman of the Federal Reserve said, look, it's probably not best to describe inflation as transitory. I think these supply chain bottlenecks are going to hang around for a while longer. And it was a signal that they were going to start raising interest rates and basically validate what the markets had already started to price in for 2022. And so just if you see here, the picture of inflation, it's gone higher and higher. The latest headline CPI in the US is at 7.5%. What I've got there is the private consumption deflator. It's a slightly different type of measure of inflation, but gives you a similar story. So the headline measure around 6%. Core, even stripping out food and energy. So again, a big part of the headline increase is due to oil prices. But even if you strip that out, the core inflation number is running at around about 4.5%. So that is really the backdrop, and the Fed is concerned that the longer inflation stays higher, the more that it could be embedded into inflation expectations, particularly with the economy strong, and particularly, as we'll see on the next slide, wages growth remaining quite strong. So to me, this is actually the biggest risk to markets. It's not consumer price inflation, because I think consumer price inflation will eventually start to subside as the supply chain disruptions ease. But we have a situation in the United States now where the unemployment rate is back down around 4%. As you can see there, that slide. So it's at the lows that we were prior to the last two significant recessions in the US, the dot-com bubble in the early 2000s, and then obviously the GFC back in 08-09. And wages growth, as you can see, various measures there, has started to take off due to those demand shortages and businesses basically being forced to offer higher pay to attract staff. Now, that is a red rag to the Federal Reserve. I mean, if we're in a position where we're at full employment, wages growth is taking off, the Fed needs to raise rates to slow the economy. Now, this is something that I don't think the markets have yet got their head around. They got their head around that the Fed is going to, gradually raise rates, which is putting downward pressure on valuations, of price to earnings valuations. But at the moment, there's the risk of recession or the perceived slowdown in the economy. Markets aren't really fearing that at the moment. The earnings outlook for the US market is still pretty strong. But again, I just pose this as a risk that unless wages growth starts to moderate from where it is now, the Fed, may end up being quite aggressive in raising interest rates, and the economy may well slow. Maybe not tumble into recession, but slow by enough that some of the earnings growth expected may need to be cut back. So we could actually have a somewhat deeper correction in equity markets under that scenario, and possibly recession, by 2023, which I'll get into at some point. But there are some hopeful signs. So I don't want to paint too negative a picture, but that is the situation at the moment. Tight labour market, rising wages, the Fed raising interest rates. If you just go to the next slide, the Fed's, as you can see here, some of the good news is that these supply chain pressures that I talked about with regard to the CPI are starting to ease. So if you look at the ISM manufacturing orders backlog, on the top right corner, you can see that's eased. It's still at a high level, so there is a backlog of orders in manufacturing. Supplier delivery times at the bottom right has also started to come back down again from very, very high levels. Other elements, Baltic Exchange Dry Index. What on earth is that? That's a measure of cargo freight rates, and you can see they've come off as well. So there are tentative signs that these supply chain bottlenecks are easing, but they are still present. So they haven't been resolved yet. But we'll see how that plays out. Just on the next slide, and this is pretty critical as well. What you can see there is the situation of the US labour market. And I just, again, you can see the unemployment rate there at 4%. Now, one of the reasons it's got so low so quickly is that labour force participation, as you can see on the bottom right, is still well below where it was prior to the COVID crisis of early 2020. So basically, with the huge loss of employment initially, we had many millions of workers in the US, leave the workforce, and some have come back, but there's many, something like 1% of the US workforce is still outside of the labour force, not actively looking for a job at the moment, and that's why the shortages and the unemployment rate has dropped as quickly as it has. So the hope is that we do get more of a recovery. And we asked, if you look closely, you can see it's starting to recover in recent months, and hopefully over the course of this year we'll get more of a recovery in labour force participation, which will take pressure off the unemployment rate and take pressure off wages. So that is the main, if you had one indicator you'd want to worry about this year, is that labour. It's an obscure stat, I appreciate, but it's actually a linchpin to the outlook for the US economy and for financial markets, US labour force participation, because that will be the difference between a soft landing for the US economy and equity markets bottoming out relatively, quickly, or a harder landing for the economy and a potential, deeper downturn in the markets. Just moving along. Other risks, and again, I'll just mention these because I often get asked about them, but to my mind, they are not the big story for markets this year. I mean, obviously, China is, I think it's best to describe China as in a juggling act at the moment. It's got a clear area of excess, a bubble in property development, fueled by, easy credit, arguably have built too many apartments. Some property developers going to the wall. Evergrande obviously attracted headlines a couple of months ago. They're managing that process quietly and cautiously. I mean, there's been some debt rescheduling, but China is basically trying to manage this quietly in the sidelines and still keep the economy ticking over. It can't really afford to have an implosion in housing construction. And so it's trying to resolve some of the issues with over-leveraged property developers, but in a way that won't unduly slow the economy. So I think, the economy is going to keep on keeping on. It's not going to fall in a hole. And the other thing about these debts is they are largely domestic debts. So the spillover to other markets should be fairly muted, provided the economy keeps ticking over. And again, it's in Chinese policymakers' best interest to have that economy ticking over, and they're going to do whatever they need to do, even if it means fueling an ongoing property bubble or debt bubble. They'll do that if they have to, ultimately, to keep growth ticking along. So I wouldn't lose too much sleep over the China outlook at the moment. Russia-Ukraine tensions, again, we're right in the midst of this at the moment. Again, all we can say is we'll see how it plays out. But I would say that if Russia did invade Ukraine, it probably would be like a 1 or 2 day wonder for markets. There'll be a lot of volatility. Equities would sell off. Interest rates would drop. Gold prices would go up. Oil prices would surge. There'd be some concern about that. But I mean, ultimately, Ukraine is a pretty small part of the global economy. Russia isn't going to invade anyone else anytime soon. So as hard as it sounds, I think the markets would sort of start to look through that. Even if there was an ongoing, battle going on in the Ukraine. Obviously, if the US and the rest of Europe got involved, it's a different situation. But, if Russia goes in, hives off a part of the country that has a lot of Russian nationalists, and you know, that may well be how it ends up. Or, you know, Russia could fold its cards. I mean, there's been, you know, there's some talk that they've already pulled back. America are threatening huge sanctions against Russia. It's very politically unpopular in Russia to invade. The Ukrainians say that they're pretty well defended. They're going to fight tooth and nail. So, you know, maybe Putin's thinking twice about it. But bottom line, I still think this is an issue that would probably be only a 1 or 2 day wonder for markets. And then we would, you know, start to refocus on the US and the situation in the United States. So just moving along, will the RBA follow? So obviously a lot of headlines at the moment about the RBA outlook. So I'll just give you my 2 cents worth on this. And you can see the situation in Australia is still quite a bit different to, you know, what we're seeing in the United States. So firstly, I showed the wage cost index in the bottom left corner there. You can see annual growth in wages on that measure is 2.2%. Now that is a dated measure. So the last reading is the September quarter of last year. The economy has rebounded somewhat, the labour market's tightened. So the next couple of readings could be stronger. And if they are, if we do get annual wage growth picking up to 3 to 3.5% over the next couple of wage readings, and the next reading on this measure comes out in late September, comes out next week, actually, late next week, then the RBA will raise rates, and possibly as early as, say, July or August. But my base case is I don't see wages growth accelerating that fast to justify the RBA raising rates this year. Now, I'm prepared to let the data make me wrong. So again, it's in the hands of the wages data at the moment. But my view is I can't see wages accelerating that fast to justify the RBA raising rates. As they said, they want to see wages pick up before they do lift wages. But either way, with the labour market, you know, unemployment in Australia is about 4%. The RBA's got it going to 3 and, you know, under 4% by the end of this year. Wages growth hopefully should continue to accelerate, in which case the RBA can start to renormalise interest rates. So, you know, even if they don't do it this year, they certainly will probably be doing it in the first half of next year, which poses issues for, obviously, you know, people are worried about the housing market. I completely, you know, once the RBA does raise rates, you know, people are competing as to how big a correction the housing market will get. I would say something like 10 to 15% decline in national house prices over the course of 1 to 2 years. If the RBA was to raise rates from, you know, 0.1% now to about 1.5% over a 2-year period, 10 to 15% correction in nominal house prices. And again, we've seen that in the past, and you know, it's completely to be expected. You know, house prices surge when the RBA cut rates, because everyone basically takes that low interest rate and bids more at an auction for a property, in the case of Sydney, for example. But so interest rates are that, you know, it drives affordability. And so people pay the maximum they can pay subject to the current level of interest rates. So when rates go up, people will be able to afford less. And as a result, I would expect there'd be a cutback in prices. But, you know, again, we've been there in the past and the economy's been able to weather it. And so I don't think it's going to disrail the economy too much. But that's, I guess, would be my base case expectation. Moving along, and just on that wages story, as I said, this is the those blue lines there. That's the quarterly, the annualized growth in, the quarterly growth in wages going back, you know, a couple of decades there, since the mid-1990s. With the unemployment rate. So you can see the last time unemployment was down around 4% back in 2007, wages growth was running at around about 1% a quarter. So that's a 4% annualized rate. At the moment, we're running at about 0.6% a quarter, which is, a 2.4% annualized rate. So there's been this trend decline in wages relative to the level of unemployment. And, you know, the labour market has become more flexible. The RBA's pointed to the fact that, you know, immigration, increase in skilled migration has meant that whenever there's pockets of labour market tightness, employers are able to bring in, you know, skilled labour from offshore, and that helps to reduce the pressure on wages. So we'll wait and see. But you know, the RBA is counting on an acceleration in wages growth back up to sort of where I've got that line there. You know, it's not, you know, not too far away from where it needs to be, but that's what we'll need to see over the next few quarters to justify the RBA raising rates. And just to point, you know, the RBA's forecast, at the moment, they don't see unemployment hitting, they don't see wages growth hitting 3% to the end of next year. So at the end of this year, they see it getting up to 2.75%, but not hitting 3 till late next year. And again, we're waiting to see if the data proves us wrong. If it does, then they'll go earlier. Just a quick COVID update before I delve into some of the investment themes. So as you can see, you know, we're you know, doing quite well on the vaccination front. These latest numbers show, you know, we're well ahead now of the US, the UK, the EU in terms of being vaccinated. So that story hasn't changed, and obviously we're now dealing with the Omicron variant, but you know, hopeful signs that we're getting past the worst of that and we'll be able to, you know, fully reopen. I mean, those that in Sydney, for example, I work in the CBD here, and if you work in an office building, you're supposed to wear a face mask in the office, and basically no one wants to wear a face mask all day, so the offices are deserted. You walk around Sydney today, it's like being here on a Sunday afternoon. It's so that's, you know, not very good news for local restaurants, local cafes, local businesses. It's good news for those in the suburbs. You know, cafes are booming in the suburbs, but inner city cafes are really struggling. But that mask mandate should be lifted the next week or so, and I would anticipate more people start to come back into the office. Just on the net, and you can see there, just the US. So the case count, they're getting through the COVID, the Omicron wave. So that you can see the count of new cases in the US has clearly peaked and has come off. The death rate has peaked and has come off as well. But you know, it's still uncomfortably high in the US. And again, it's one of the reasons why labour force participation is still low. Many people are either, you know, suffering from COVID or scared of getting COVID, or, you know, vaccine mandates and they're not vaccinated that prevent them from working. So they're still dealing with COVID. And you can see our case as well. We've, you know, lower overall numbers, but we've also peaking and you know, starting to decline. So, you know, knock on wood, hopefully we don't get another wave. But even if we did, you know, hopefully the next wave would be a variant that's even less severe than Omicron has been, and we can, you know, quote unquote, learn to live with the virus a bit better. You know, we don't have to lock down again. You know, that is my hope, that we, you know, learn to live with the virus and you know, deal with those that are most at risk. But everyone else can sort of go, you know, try to go back to their normal lives. Yeah, so, and you can see here, this is like a real-time indicator of activity. Actually, it's mobility trends from Google Apps, and so it tracks, you know, the number of people, you know, seeking driving services or moving around using public transport. And, you know, it's a bit messy, but you get the broad trend there. We had a bit of a dip late last year, early this year, and this is for the United States and Australia, but those mobility trends are starting to recover. So it does show you that economic activity after a dip around New Year, Christmas, New Year, is starting to recover. So let me just spend the last section there on some investment themes and ideas. And firstly, look, upward pressure on bond yields. So the first slide there is US 10-year bond yields, the market's expectation for the Fed funds rate over the following 12 months. And as you can see, from a period of not expecting much tightening up through most of last year, you know, they were expecting tightening in 23, but not so much 22. They've now, you know, priced in aggressive tightening, something like 1% tightening on a one-year basis. And my modelling of 10-year bond yields would say, based on that, 10-year bond yield should be up around about 2% or so. In fact, we're not far off that at the moment. So my model is still holding up. So bond yields are basically where they should be. And I've got 10-year bond yields in the US continuing to grind higher, and I've actually got a target of 2.25% over the first half of this year. So at some point over the next quarter or two, we should get 2.25. I don't see it going much beyond 2.25. So that's, if there's some good news there, because to get beyond that, you've got to think that the Fed is going to be raising rates, beyond say 1.5, 1.75%. And I just can't see them being that aggressive within the next couple of years. They may need to be, going back to that wages story, but provided, the markets don't price in a Fed funds rate going beyond 2%, then 10-year bond yields, shouldn't get much beyond 2.25, 2.5%. And so they're already at 2% today. But that will put pressure on equity markets, as I'll show you in the next slide. Yeah, so just a snapshot of the US equity market. You can see the rebound in prices. The first point I just put, at the bottom right corner there, you can see the price to earnings ratio for the US equity market, still at 20 times earnings. So you can see COVID led to a surge in valuations up to 22 times earnings. And that was because initially markets rebounded even as earnings collapsed. So earnings did collapse in the first part of 2020, but the markets looked through that and thought, we're going to reopen, there'll be better times ahead. And so earnings falling, market rebounding, PE ratios went up. Now through 2021, you can see that the PE ratio has been declining. So over the course of last year, that PE ratio went from 22 to 20. So it's actually a 10% decline in valuations. Equity market didn't fall because earnings were still growing, and earnings grew by 20 to 30% in the US last year. So it was more than enough to offset the decline in the PE ratio. Now, so the outlook this year is that, sorry, if you stay on that first slide, I see that PE ratio continuing to come down. Again, the average since about 2013 has been 17.5, and I use that as a period because that's been the period where bond yields have been around a flat trend of about 2%, as you can see on the bottom right slide there. Prior to 2013, there'd been a long-run trend decline in bond yields. Since about 2013, they've leveled out. I mean, there's obviously been cycles, but the trend has been flat at around about 2%. So that's my rough metric of fair value for the market is 10-year bond yields around about 2% and a PE ratio of around about 17.5. In the short run, I see bond yields going a bit higher than that, but I actually see that the PE ratio coming back down to say about 18. So that's another 10% off. But earnings growth, the big difference this year is that earnings growth is still going to be positive, but not as strong. So it won't be 20 to 30% growth. It might only be 10% growth, which is still pretty good. But it's going to be, provide less of an offset to valuation. So it's a more muted outlook for equities. In terms of market, we've had a 10% correction in the US market already. So up to at the low point of the US market a couple of weeks ago, the downturn was 10% for the S&P 500. It wouldn't surprise me if we do get more downside of something like 20% even at some point over the next few months. If you go back to 2018, the correction in the market over that year when the Fed was raising rates was about 20%. So it could be a deeper valuation-led downturn in the short run, then with some recovery in the second half of the year on hopes that the Fed won't be much more aggressive than what's already priced into the market. Bond yields stabilise and the market can then rebound somewhat based on earnings. So that's sort of my base case scenario. Not a super strong outlook for the US market overall, or for global equity markets really for that matter. But nonetheless, not a massive, a slump in markets, more of a mid-cycle correction, as we call it, on the basis that, the Fed won't, the US economy won't tumble into recession. So we just go to the next slide there. And again, this is the drawdown of the orange slide there is the decline in the US market from its peak levels. And so, a decline of more than 20% is considered a bear market. And I just wanted to highlight those areas in grey are US recession periods. And you can see the biggest sustained equity drawdowns are when you get US recessions. And so COVID was a case where we had a very short, sharp recession. The market at one point was off 30% in the US. That's on a month-end basis. So on a month-end basis, the market was down 20%. You can see in the last two recessions, it was off something like 50%. And the declines, it took a year or so for the markets to bottom. So that's a classic recessionary type bear market. which hopefully, I don't think we're coming into, but that, when and if the US does eventually succumb to the next recession, that's a sort of situation we may well find. And the reason is that not only do PE valuations come off, but earnings also decline, which is that blue line there. What you see outside of recessions is where you can get corrections, so that orange line dipping, but earnings holding up. And so that's a sort of a correction. If you get a 10 to 20% decline in prices with earnings holding up and you don't get a recession, that's a correction in the markets with an ongoing bull market. And I guess 2018 was the last example of that situation. So again, in terms of big bad bear markets, and if those have been to these webinars in the past have heard me say this, you need to be worrying about a recession. If it's not a recession, if you're not at serious risk of recession, then what we're looking at is a correction, which can still be painful if you're not used to it. But we've had a up to a 10% correction already, but maybe we need to test a bit lower over the next few months. And just on that, I mean, recession fears are still pretty low. So this is a Google search of the title of recession. As you can see, we had a few spikes during COVID. The last one was obviously during the GFC. But at the moment, people aren't fearing recession. People aren't searching for it. It's not being quoted in the media, which is good news. But as I said, never say never. And I'm worried about that labour market in the US, because that could be a catalyst for something more serious. Just moving along. And what I've got here is some key indicators of recession in the US. And you can see the unemployment rate is already at the lows that we've seen in the last few recessions. So the unemployment rate is, again, already low enough to say, hey, this is late cycle. There's a risk of the economy needing to turn down. But other indicators, so you can see there, the federal funds rate, that's the rate that the US Federal Reserve, their official cash rate, typically has been increasing for a year or so before you tumble into recession. So the Fed at the moment hasn't even begun to raise interest rates. So just on that measure, you'd think that there's some time away. The yield curve is another important measure. That's the gap between 10-year and 2-year bond yields. You can see that's still positive, and typically that's gone negative up to a year before a recession. So again, when the Fed has tightened rates, and it's tightened rates for a while, you get a situation where the curve, 10 years, 2-year bonds go up relative to 10-year bonds, and the curve inverts. And when that inverts, it's a sign of policies become restrictive. And again, historically speaking, it's been a pretty good indicator that there could be some troubled times ahead. But again, at the moment, it's still positive. And the other one I point out there is the profit margins in the US. Quite interesting that usually they peak midway through an expansion and then decline. As you can see, they declined during COVID. They've rebounded very strongly. And so far, no signs of a decline yet. So again, as another indicator to say, risk of recession at any time soon is pretty low. But these are the sort of indicators I'm watching as the Fed does start to raise rates to see, what sort of impact it is having on the economy. Just going to the next slide. Australia, I talk a lot about the US. I thought I'd put the Australian sort of fundamentals pictures up there as well. You can see our PE ratio has actually declined quite substantially. We touched up to 20 in 2020. We're now down to about 16 on the back of the fact that our market, it's done okay, but it hasn't done as well as the US market. So we've been pretty sluggish in terms of price performance. And we've had a bit of an upturn recently in the earnings outlooks. If you look at expected earnings for 21, 22, there's been a bit of an upturn lately, which is pretty good news. But yes and no good news. So the market's not too badly valued. It's hard to see on that line, but the expected level of earnings in 23 is not much higher than 22. It's actually like around about 3 or 4%, whereas globally it's 10%. So our market overall is still earning challenge. We're not looking at a very strong earnings growth going forward, which is going to constrain our market somewhat. But at least on a valuation basis, we're looking okay. But in the main, I think our market is still going to have a tendency to have an underperforming bias, which means whatever the US market does or global markets do this year, we'll probably do a little bit less than what they do. But we're basically going to follow their movements. And there's no point just only looking at Australia and trying to figure out what the market's going to do, because it's really dependent on the US. Where the US goes, we tend to follow more or less, as we've seen just in the past few months. Just moving along. And as you can see there, on that PE basis, we are starting to look a little bit cheap to global markets. So we're trading at a bit of a discount on a PE basis. But this has been the challenge for our market over recent years, is that you can see on the bottom slide there, relative returns, we've tended to underperform markets since the peak, global market, since the peak of commodity prices back in 2010. And that's because earnings growth has been relatively weak in Australia. So that's the Australian earnings relative to global earnings. And until that picture turns around, it's hard to be bullish on Australia vis-a-vis global markets. Moving along to the next slide. So RBA, market is expecting the RBA to follow. You can see there the pricing in, aggressive interest rate increases. So that's the expected cash rate 1 year ahead, around about 1%. And as you can see there, from a very flat outlook for over the past couple of years since COVID, it's certainly changed markedly in the past few months. And again, it's on the back of the Fed. It's quite funny, that the RBA hasn't changed its signalling in large part. Yes, we've had a bit of an upside surprise in inflation. We've had better than expected labour market numbers. But the markets, the RBA have been saying we still don't see a case to raise rates anytime soon. But the markets are basically ignoring what the RBA is saying, have started to price in aggressive rate rises. That may happen, but as I said, we need to see what happens on the wages front before you can be confident of that anytime soon. Just going to the next slide, just a summary of some of the major equity themes. You can see, just to summarise, Australia's tended to underperform, the US has tended to outperform. Growth versus value, so technology versus things like financials. You can see it's been of a sideways trend since COVID, and more recently, growth has started to underperform value. So look, the main thematic at the moment is because bond yields are going higher, high-priced technology stocks, companies with high potential for growth in the future, but trading at high PEs, have been really under pressure because as interest rates go higher, those high-priced stocks tend to underperform. And again, I see that remaining as a trend for the next 3 to 6 months at least, until we get a peaking out of bond yields. So areas of the market like energy stocks, financial stocks, like our BNKS Global Banks ETF, FUEL, Global Oil Producers ETF. These are the sorts of exposures that are currently doing relatively better. Some of the technology exposures, the NASDAQ, of course, and even some of our technology thematics like cloud computing, hack, things I've loved for a long time. Many of you would have heard me talk about these in the past. They are under some pressure in the short run, given what's happening with bond yields. And but again, if you do like technology from a longer run point of view, it could be a buying opportunity as they possibly come under some more downward pressure over the next few months. Just moving along, I won't dwell too much on that. And just to show you there the technology, look, just to show you the relative performances there. And technology has been trending higher for a long time. Banks, energy have been trending downward, but there's a bit of a rotation going on at the moment. Banks look relatively cheap on a PE basis, as you can see there. Energy, not too bad, but still being supported by earnings. And technology on a relative PE basis is looking, a touch expensive at the moment relative to, say, something like banks. And healthcare, look, healthcare had a big run during COVID. It's sort of correcting some of that premium, that extra premium it got during that COVID. But again, healthcare, I think, from a long run perspective, will do well. But it's just, I think, just having a bit of a pullback at the moment is that all those COVID-related companies that did so well are now under a bit of pressure as economies shake off COVID and start to reopen. Moving along, Aussie dollar, I've still got going weaker. I've got 68-cent target on the back of, again, the RBA not raising rates, the Fed raising rates, so that negative interest rate differential should work against us. I've got iron ore prices weakening as well. China just announced yesterday that They're looking at the iron ore market a bit more closely. They're not happy with iron ore prices back over $100 a tonne now, around about 120 or so. I actually see it eventually gravitating back below 100. So the combination of two should send the Aussie a bit lower. So I'm a Aussie, not, we're just over 70 at the moment. I see it peeling back another few cents. Would be my expectation over the next few months. Moving along, and just to highlight those various growth exposures out there. I mean, global quality. I mean, the highlights here, as I mentioned, the high growth potential tech thematics, things like ATech in Australia, HAT Robotics, Asian technology companies, the Nasdaq. These are things that are under pressure in the short run. Truth be told, and there's probably a bit more pressure to come. And even things like our new ETF Crypt, the pullback in cryptocurrencies are under some pressure. So, it's from a long run perspective, I still love these exposures, but in the current environment, this is the time where they're going to remain a bit under pressure. Inflation exposures, so resources, again, I mentioned fuel, energy producers, they're still doing very well. Food, so global food producers are doing quite well as well. Gold, QAU. Gold's not done too well, hasn't done too badly, but it's just sort of meandering in a sideways kind of range at the moment. So despite all the inflation talk, gold hasn't benefited to a great degree. But again, just if you are interested in gold, if you like gold, very easy way of getting that exposure through QAU, which invests in gold bullion bars. So just highlight that again. And some of the value exposures I mentioned. So BNKS is really my standout exposure in a period where bond yields are rising, central banks are raising interest rates. If you don't get a recession, then the increase in interest rates helps the profit margins of global financial companies. Our banks are also doing relatively okay. We've had some very good profit numbers out of the banks recently, and I've already mentioned fuel. So financials and energy are the go-to kind of exposures in this type of environment. Japan also, I mean, not so much Europe, but I do like Japanese market. It looks cheap, certainly versus the US. It's shaking off COVID. Earnings growth is good. So that's another, interesting exposure outside of the ones that I've been talking about a lot of late, previous webinars like US technology. And QUS is the equally weighted US ETF. So it's the S&P 500, equally weighted. So it does give you US exposure, but with less exposure to the tech companies, which are the big tech companies, which is, the S&P on a market cap basis at the moment is very heavily weighted to the tech companies. So if you want more of a mid-cap type of exposure, then QUS is an interesting one to think about. So that's pretty much it. What have we hit? We've hit 11:44. So just as Chris mentioned earlier, just some general information only. Obviously, if you can and you're interested, seek professional advice before investing. All of our funds that I've mentioned do have product disclosure statements. They're all available on our website, so you can certainly get a lot more information on all of the exposures, ETFs that I've mentioned on our website. Look, I'll leave it with that and see if there's any questions.
Yeah, thank you so much, David, for covering that. And there are a few questions to get through here, so we've got, I guess, plenty of time to do that. So, look, just to start off with, I know, David, that you went through, I guess, what you're looking in terms of inflation, some of those indicators in terms of the demand shock and also supply side and how they're coming off slightly. There is a question here in terms of what are the indicators in terms of inflation where it has become entrenched rather than transitory? I know we're not supposed to call it transitory, that you would be looking at.
Yeah, good question. I mean, wages, wages is a sign that wages are, if wages keep going the way they are, that's another cost factor that can get embedded into prices. And so that's one sign. So again, that's not a helpful sign. It's good about, on the one sense, the lower paid workers in the US are now getting wage rises, which from a social point of view is good news. Income inequality in the US is very, very bad. And from an economic point of view, it's good news because, lower income people tend to spend more. If you give all their money to higher income people, they save it. They can't. So the income inequality is actually having a depressing effect on the US. So in many respects, higher wages is good news for the economy, both socially and economically, but you don't want too much of a good thing. So 3% growth is good, 3 to 4. You don't want 4 to 5. So that's point one. That needs to slow back down to a 3 to 4% pace. Inflation expectations, there's various survey measures of inflation expectations, both of households and of the markets themselves. So if you look at 10-year bond yields, as you may know, some of you may know, you can buy a bond that's indexed to inflation. So basically, it gives you a capital growth over time in line with whatever the CPI is doing. And so the yield on that is like a pure yield. And so if you look at the yield on nominal bonds and you take away the yield on these indexed bonds, you get effectively the market's expectation for inflation over time. So to equalize the two, for you to be indifferent between owning either of those bonds, then the extra yield you're getting on the nominal bonds is implicitly what the market expects inflation to be over the long run. Now, at the moment, that's still only around 2 to 2.5%. But if that were to accelerate, bond yields went high and inflation expectations picked up, that would be another sign that inflation is becoming entrenched. But at the moment, those inflation expectations are still relatively contained. The markets are giving the Fed the benefit of the doubt that they are going to raise rates, which is going to contain inflation over the longer run. And as I mentioned, there's a few survey-based measures of inflation expectations from households. They tend to whip around, so they tend to follow current inflation. So inflation's gone up, so households are now fearing, higher inflation to some extent. So it's a bit of I wouldn't necessarily, see that as a good read, but the Fed would be wary of that. But they're the bunch of things that people look at, and I'm looking at.
Fantastic. And look, here's another question just in relation to, I guess, the supply chain side of thing. And obviously that's had a huge disruption in terms of businesses and countries being able to get the right goods and services in. With that all happening though, it seems that, and the question here is, given that enormous disruption in global supply chains, it hasn't really sort of affected, barring the last couple of months, the markets. Why have those markets remained stubbornly high, even though we've had these supply chain factors happening around the world?
Yeah, it all comes back to the idea of being transitory. So last year, inflation in the US did take off, and it was higher than expected. But the Fed, if you recall back early last year, through most of last year, Jerome Powell, the Fed chair, was saying, we think inflationary is transitory. It's going to ease as supply chain bottlenecks ease. So even though inflation was high, the market was able to look through it because, the Fed was saying we're not going to react to it by jacking up rates. The Fed changed their mind ultimately late last year when inflation, undeniable, was much higher than expected, and it was lasting a lot longer than expected. And as I said, wages growth was starting to pick up, the unemployment rate was getting tight, and so it's been the Fed shift, the Fed pivot, the more hawkish rhetoric from the Fed that has really changed the markets around. And go back to early, we had a bit of a pullback in the markets in early 21 as well, and because we had a move higher in bond yields, and so it is. Basically, back in 2020, central banks slashed rates. So would you believe US 10-year bond yields, our bond yields weren't too far away. They were at 0.5% in mid-2020. US 10-year bond yields at 0.5%. Then through the course of last year, they went up to 1.5%. So the markets were able to wear a 100 basis point move in bond yields. And the other point being, so bond yields did go up, and PE ratios last year did go down. And as I said, they went from 22 to 20 in the US. So it was a 10% decline in valuations. But earnings growth was so strong, V-shaped recovery in earnings growth, that more than offset it. So not only the Fed saying it was transitory, it was just the sheer strength of earnings last year allowed markets to keep rising. So the difference this year is that earnings growth is still solid, it's still positive, but it's just not going to be as strong. Meanwhile, the upward pressure on bond yields is as great as it was last year, if not greater.
Excellent. Thank you for that. Another question here is, how concerned should we be about the level of debt that countries are currently carrying?
Well, I get this question a lot, and the reality is the debt situation globally is very, very high. It's high in different countries for different reasons. So the US, it's high public sector debt, and now the US is a reserve currency. People need to own treasuries. The Federal Reserve has bought a lot of that debt. At the moment, it will need to eventually sell it back, some of it to the market, but the Fed can hold on to those bonds for as long as it wants. It's under no obligation to sell them back to the market. So if the Fed sold bonds in a way that was disruptive to bond yields and caused a market sell-off and a financial market disruption, it wouldn't sell those bonds. So that's the Fed. The other reason, obviously, it would be disruptive if the inflation did start to take off and it was stayed higher for longer. Bond yields would go higher, and people would find refinancing their debts at higher interest rates would be very problematic. So again, a lot of this debt has been taken on in a low inflation, low interest rate world. If that world changes, problems begin. So it is problematic if inflation picks up. I'm still a lower for longer inflation person. So I think over the next couple of years, inflation will drop back down almost to where we were, maybe a little bit higher. But basically the structural features of globalization, and I know people talk about onshoring and supply chain shortening, but ultimately, tech disruption, robotics, these sort of things are still going to keep, I think, costs and prices pretty low. Areas like in the US, in China, debt's also very high. A lot of it is corporate debt. A lot of that is effectively backed by the government. As we're seeing at the moment, they're managing the corporate debt fallout by some of the property developers. So it's, I wouldn't say not to worry, but I mean, I see we've lived with it for a long time, and I think we'll continue to live with it without it being too disruptive, subject to that inflation picture that I painted.
Excellent. And look, there was a lot of questions coming through around, I guess, the NASDAQ fund, tech exposures, and one here, I know that you've touched on it, but just to sort of, I guess, go over in a bit more detail, can those large tech stocks like Alphabet, Microsoft, and Meta grow or at least hold on to their recent gains since, mid-2020 in this view of an increasing interest rate environment?
Well, within the tech area, I think they will outperform. So, look, they've all come off, but I mean, the corporate earnings of, Facebook's a special case. I mean, some of this is stock specific. So Facebook, those that are following it, anecdotally, I've never, used Facebook all that much, so I don't know if it's popular or not. But obviously, the word is that it's less popular with younger people. They're moving to things like TikTok and whatnot. So their core business is under challenge. They're moving into the metaverse, which is very costly up front. They took an earnings hit. So there's a bit more uncertainty over the business model, the outlook for Facebook, a bit more uncertainty over Netflix too, with the rise of alternative streaming. Once upon a time, they had the market to themselves, and now you've got, the Disney Channel, you've got Google TV offering up easy ways to get streaming. But Google itself, to me, Google, Apple, Amazon, I mean, these are super strong, companies with, very strong business models, Microsoft as well. So in the FANG area, there are some stock-specific risks, but the vast majority of them, I think their business models are still very strong and are likely to hold up. And, to the extent there's a pullback in Google, I mean, I think that's a good buying opportunity. They quietly still, powering along very well. The risk is in some of the other, the more highly priced, less earnings, with not a lot of earnings visibility at the moment. That's where we're seeing the bigger corrections happening, and that's again a function of interest rates. It's a function of market expectations too. If everyone thinks that these high-priced stocks correct when interest rates go up, then as interest rates go up, they will correct because it's like almost a self-reinforcing expectation that's happening. But Yeah, so I think they won't be immune to a pullback, but they should hold up relatively better than some of the what I call the blue sky tech companies that are out there.
Excellent. Thank you very much for that, Dave. And another question here from Bill was in relation to your view on the Aussie dollar and obviously that weakening against the US. Would it be better to consider unhedged overseas funds or ETFs rather than hedged, given that view?
Look, in the short run, yes. I mean, on the view that the Aussie could drop another couple of cents. Over the long run, depends on your time frame. If you wanted to punt on the currency, for example, if you agreed with me and you thought the Aussie was going to go down, you could buy like a USD ETF, which gives you exposure to the US dollar. So, and without taking on any equity risk. You can buy equities, and if the Aussie dollar goes down, then unhedged equities will benefit from that. But if equities go off, if the Aussie falls because equity globally are falling, then you may end up that you're sort of not that better off. But if it's a question of hedged versus unhedged in the short run, if you're definitely of a view to buying equities, and the Aussie is expected to weaken, then unhedged would make sense. But I wouldn't buy unhedged equities just because you have a negative view on the Aussie, because you can actually buy a currency ETF, go to our website and have a look to take that position if you want to take a view on the currency.
Excellent. I think we've got time for one more, given that we're supposed to wrap up at 12. So here's one for you, David. What impact on Australia does the upcoming election, I guess, in your view?
Well, interesting. I mean, unlike last election, of course, we had the Labor Party last time around with a lot of, tax proposals, which they wanted to go, to the election with a positive agenda, be seen to stand for something, and they got blown out of the water, scare campaign. So it's very much a small target, let us try to squeak home this time around. So there's no big brash tax policies this time around. So the level of uncertainty that we saw, which did affect markets to an extent in the lead up to the last election, isn't going to be around. It's probably going to be a very boring election with not a lot of policy proposals out there. So generally speaking, elections don't have a big impact on the markets. It's usually elections having an impact on markets is more the exception than the rule. Last time around, it was the exception, but this time around, we'll probably follow the rule. I can't see a case for, major impact. I mean, the one thing economists do note is that around elections, consumer confidence, you tend to get a bit of a dip in retail spending around election times. But I wouldn't, get too worried about that. I think the outlook for the economy is still pretty good, so I don't see the election really threatening that all that much. One caveat to that, of course, I should point out is if to the extent we get a hung parliament, if it's an uncertain result where, independent candidates will basically decide who is the government, and that will take a few weeks to get sorted out. And then we have to deal with, what will the independent candidates want as a policy, package to get their support. That's where we could get some market, volatility, market nervousness if the election result is as we saw, a couple of elections ago, a hung parliament, which can't be ruled out.
Fantastic. Well, thank you very much, David, for covering that webinar and Echo market update and answering those questions. And again, thank you for everyone that's come on and attended today. As mentioned earlier, if you want any additional information, do jump on our website. There's a heap of resources there, and you'll be able to see all the upcoming webinars that'll be coming on. And hope everyone has an enjoyable Thursday. And great being back in 2022.
Bye for now.